All right, let's talk about something every business owner faces. You need gear to get the job done, but paying for it all up front, that can seriously drain your cash. So how do you get the equipment you need to grow your business without, going broke? Let's dive in. This is the classic problem, right? You know that new truck, those new computers, that new piece of machinery, it's gonna make you more money. But man, that upfront cost, it's a huge hurdle. It ties up cash you desperately need for payroll, marketing, just keeping the lights on.
And look, it doesn't matter what industry you're in. Whether you're moving earth with a tractor or moving data with a server, having the right tools for the job is absolutely non-negotiable if you want to grow.
So when you're standing at this crossroads trying to figure out how to get that gear, it really all boils down to two fundamental choices. This is the first big decision you have to make.
And here they are, plain and simple. You can finance it or you can lease it. The easiest way to wrap your head around this is just to think of it like buying versus renting a house. Financing is your path to actually owning it. Leasing, well, that's basically a long-term rental agreement. So let's look at the trade-offs. On one hand, you've got financing, the buying route. The huge pro, you own it. You're building equity and you can get some killer tax deductions. The downside, your monthly payments are usually higher, and yeah, if it breaks, you're the one paying to fix it. On the other hand, there's leasing. The payments are lower, you can get the newest tech easily, but you never own it, and the tax perks usually aren't as good. So it really comes down to this. What's more important to you right now, long-term ownership or short-term cash flow? Okay, so let's say that renting path, that leasing option, sounds pretty good. Well, hold on, because it's not quite that simple. You need to know that not all leases are the same. Let's break down the two main flavors you're going to come across. First up is what's called a $1 buyout lease. Now, the name sounds a little funny, right? But it's basically a lease with a secret identity. It's designed from the get-go for you to own the equipment at the end of the term for a single symbolic dollar. Because of that, accountants and the taxman, they treat this a lot more like a loan than a rental. Then you have the fair market value lease, or FMV for short. Now, this is a true rental. It's all about flexibility. When your lease is up, you've got options. You can just hand the keys back and walk away. You can sign up for a new lease, maybe with newer equipment, or you can decide to buy it for whatever it's worth at that moment. So when do you use which? Well, it really depends on the gear. That $1 buyout lease is perfect for the heavy hitters, the stuff that's built to last and holds its value, like a crane or a bulldozer. You're in it for the long haul. The SMV lease, though, that's your go-to for anything tech-related that gets outdated fast. Think computers, servers. Things where having the latest model is way more important than owning last year's news. Okay, let's get to the juicy stuff, the part that really truly impacts your bank account. We're talking taxes, and we're talking about what lenders really care about when they're looking at your application. This is where your choice can have a massive financial impact. So take a look at this number. Whoa, $1,050,000. What on earth is that about? Well, believe it or not, that huge figure points to one of the biggest, most powerful advantages of choosing to own your equipment.
The answer is something called Section 179 of the U.S. Tax Code. And seriously, for a small business, this is an absolute game changer. It means you might be able to deduct the entire purchase price of your equipment in the very first year you own it. That's a huge tax write-off, and it's why financing or using that $1 buyout lease can be so incredibly powerful.
All right, here's another key number for you. It's a lot smaller, but in some ways, it's just as important. In fact, this one's all about you. Yup, we're talking about your personal credit score. Even though it's a business loan, many lenders see a score of 650 or more as a really strong signal that you're reliable. It's not the only thing they look at, of course, but it's often the first hurdle to clear to get the best possible rates. So let's say you've done the homework, you've weighed the pros and cons, and you know which path you're going to take. Awesome. Now it's time to get your ducks in a row and build a rock-solid case for the lenders. Think of this as your application toolkit. You'll need the basics, like the application and a quote for the equipment you want to buy. But you'll also need to show your history with things like financial statements and personal tax returns. And hey, if your business is still pretty new, a sharp business plan is absolutely crucial to show lenders you know where you're going. Having all this ready to go, man, it makes the whole process so much faster and smoother. But wait, we're not done yet. Financing isn't just about getting new stuff.
Let's get into some next-level strategies you can use to unlock the cash that might be just sitting there, locked up in the equipment you already own. One of the most common strategies is simple equipment refinancing. You can think of it just like refinancing your house. You're basically swapping out your old loan for a brand new one, and the whole point is to get a better deal, maybe a lower interest rate or a longer term that lowers your monthly payment and frees up your cash flow.
Now, this next one is really clever. It's called a sale and leaseback. Here's how it works. You sell a valuable asset you already own to a finance company. They give you a big lump sum of cash for it. Then you immediately sign a contract to lease that exact same piece of equipment right back from them. So you get the cash, and your business doesn't miss a beat. Pretty smart, right?
You know, at the end of the day, there isn't one right answer for everybody. This quote from Forbes Advisor really just nails it. The best choice for you depends on your budget, what kind of gear you actually need, and maybe most importantly, how quickly that gear becomes a dinosaur in your industry. So that leaves us with the one big, crucial question you have to ask yourself. That next piece of equipment you need, is it an asset that you want to own for the long haul, something that will build value in your company for years? Or is it simply a tool that you need right now, where flexibility to upgrade and adapt is way more important? Your answer to that question, that's what will tell you exactly which path to take.